Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Dr. Derek Horstmeyer, Professor of Finance at George Mason University and a regular contributor to the Wall Street Journal. His research focus areas include ETFs and mutual funds. So we are talking about a number of very interesting ETF as well as mutual fund related topics today. Dr. Horstmeyer, welcome back. Really looking forward to this discussion.
Thank you, Neena, for having me back. Yeah, I look forward to the discussion as well.
So I wanted to start with the ETFs tax efficiency. And we have seen that in the past few years, mutual funds have been losing assets at a record pace. And a lot of that money is flowing into ETFs. And that's mainly because ETFs are generally cheaper, but more importantly, they are more tax efficient due to the way they are structured. In fact, last year, when investors lost a lot of money on their stock mutual funds as well as bond mutual funds, about 60% of equity mutual funds distributed capital gains. That is according to Morningstar data. On the other hand, just 4.5% of stock ETFs distributed capital gains last year. So you did some study on the magnitude, exactly how much tax savings investors enjoy if they invest in ETFs and not in mutual funds. Could you tell us about that?
Yeah, I've always been told, ETFs are more tax efficient than mutual funds, but nobody ever really quantified how much more that was. So my research assistants and I decided to kind of jump in and just isolate how much more tax efficient an ETF is. And to do that, we really created a set of matched pairs where we looked at within the same fund family. So for instance, Fidelity. Fidelity might have two different fund offerings of the S&P 500. One might be the Fidelity S&P 500 ETF, and the other one would be the S&P 500 mutual fund. And so we matched those two up, and they were matched based on, expense ratio and benchmark and holdings and everything else. So really, the only difference was the wrapper. Was whether it was wrapped up in a mutual fund or an ETF. And we looked at the post-tax returns of these matched pairs and just kind of examined how much more tax efficient really are ETFs. And in general, we found it was about 20 basis points per year. So in a taxable account, you can save about 20 basis points per year by going with the ETF over the mutual fund, all else equal. And we found that the most tax efficient was the international equity ETF. So international equity, you could save about 33 basis points a year by going with the ETF over a mutual fund. And so we found this pretty interesting because that adds up to pretty big savings over the long run. Just in about a 4-year period, you're already up to about a 1 percentage point difference.
That's a significant tax saving for sure. 20 basis points over a long-term horizon can make a lot of difference. So very interesting findings for sure. So when investors look at mutual funds, they normally look at the turnover ratio because they think that if the turnover is more, there is more buying and selling of stocks, then probably there would be greater capital gains distributions. But your study found that turnover ratio may not always be a good way to identify tax inefficiency of a mutual fund. Could you please expand on that?
Yes, exactly. So a few months ago, another study that we did for the Wall Street Journal um, was, again, looking at the turnover of the fund. And again, I've always been told, and I teach my students this, that all you have to do to look at how tax efficient a fund is, check on their turnover. How many stocks are they selling or buying in a given year? And so we kind of decided to look at the data on this. And so we looked across fixed income, emerging markets, small cap, large caps, you name it. And we kind of found a pretty muddled picture. And so we didn't find that the opposite was true, but we found that in kind of half the cases, the low turnover funds were actually more tax efficient. And in half the cases, the high turnover funds were. So kind of just a muddled picture, kind of highlighting that turnover doesn't really predict how tax efficient a mutual fund is. And we're kind of surprised by that, but it kind of makes sense. What's lost in a turnover measure is, are they trading long-term capital gains, short-term capital gains? Are they tax loss harvesting? They could be doing all sorts of things within that turnover that's not captured by that turnover measure.
I had mentioned inflows into ETFs earlier. Now, this year in particular, we have seen massive inflows into bond ETFs, and that is mainly because of the stock market uncertainty, and also because yields are now at levels not seen since the financial crisis. So earlier we used to hear about Tina, there is no alternative to stocks, and instead people are now talking about Terra, that they are reasonable alternatives, and there are many other interesting acronyms too. So one of your recent studies looked at what type of bonds deliver the best returns over the long term and short term as well. So please expand on that.
Yeah, another fun study too for the Wall Street Journal. Yeah, everybody's been clamoring to get into bonds this year, or even over the last year too. We're seeing everybody pile into money market instruments, just because you're right, you can get an actual return now for the first time just investing in a 3-month T-bill. So we kind of looked at this over the long run, just to kind of give investors a picture of what does the best over the long run, on a risk adjusted level. I should be very clear. And we kind of found that for the full sample, US long-term debt did the best over the long run. When interest rates are rising, which we're kind of still in that period now, when interest rates are rising, we found ultra short-term debt did the best. And when we're in a recession, we found surprisingly that Ginnie or mortgage based debt did the best. And so that was a little bit of a surprising result. And these were all kind of on a risk adjusted level. But yeah, it was interesting to see that mortgage based debt actually did the best in a recession. And yeah, so we were a little bit surprised by those results, but it does kind of make sense that when interest rates are rising, ultra short-term debt would do the best, and over the long-term debt would perform the best.
Very interesting findings for sure. Yes, a massive inflows into money market mutual funds, as you mentioned, and on the ETF side, ultra short fixed income ETFs have been very popular. And as your study confirmed, these tend to do well when interest rates are rising. And for investors who are worried about the economy falling into a recession later this year, as many experts are predicting, they'll probably look at mortgage-backed securities and related ETFs. So another interesting study that I saw, and I think that was also for the Wall Street Journal, you looked at the best time to trade ETFs. So tell us, what is the best time of the day to buy or sell an ETF?
Yeah, that was another fun one we did. Just because, again, I've always been told, you want to buy when there's the most traded volume out there. And so we kind of know that a lot of trades obviously happen at the very open of the market and at the very close at 4 p.m. But we went in and actually looked at the top 10 traded ETFs out there and then recorded their bid-ask spread throughout the day. So I did this with the help of a bunch of RAs, and we kind of tracked how the ETF bid-ask spread is changing throughout the day. And so we looked at the first 5 minutes of the market open, then 2 hours later, then midday, and then at the close. And we kind of looked at, well, if you were to place an ETF trade, when would the bid-ask spread be the highest? And what we found was the bid-ask spread basically across all of these stock ETFs and bond ETFs was right at the market open in the first 5 minutes. And then it went down quickly and kind of stayed there. So it didn't really matter when you placed the trade as long as you avoided the first 5 minutes of the market open. And again, I should note this is for kind of the most active and the biggest ETFs. We didn't track the thinly traded ones. We really track the ones that most people are trading. And we found this interesting because at the market open, on average, it's about a 2 basis point bid-ask spread. And then the rest of the day, it's about a 1 basis point bid-ask spread. So we're not talking monumental differences here, but a basis point every time you trade does add up over the long run if you're placing, if you're a financial advisor and you're placing 100 or 200 trades a year for your clients, it adds up, obviously. And so we were interesting to see that the highest bid-ask spreads are right when the market opens, and that seems to be the time that you want to avoid trading.
Right. So the reason that I can think of is that because ETFs are basically basket of stocks, and some ETFs, they hold like 500, 600 or even more stocks. And some of those stocks may not start trading at the open. They may start trading after 5 minutes, 10 minutes or so. So when those underlying stocks are not trading, then the market maker would not give you a good price for the ETF, right? Do you agree that is the reason for those higher bid-ask spread?
Yes, exactly. Yeah, so we didn't get into the underlying reason, but yeah, that could be reason number one. There's obviously a lot of price discovery that's happening in those first 5 minutes.
Right.
But yeah, exactly. That could be the reason.
Okay, so trade during the days, avoid maybe an hour after market open or half an hour?
Yeah, we saw it clear up pretty quickly. An hour later seemed to be fine.
Okay, very interesting. So let's talk about market valuations now, because we hear this so often on CNBC and Bloomberg that S&P 500 is now trading at this valuation. So stocks are too expensive, due for a correction, or stocks are too cheap to ignore. Particularly after last year's market plunge, many experts started talking about, these stocks are now too cheap to ignore. And same thing we are hearing about small caps very frequently, that small caps are too cheap to ignore. But you looked at creating these valuation-based portfolios and whether it is possible to time the market by looking at market valuations. And your study, the results were very interesting. Tell us about them.
Yeah. So this was another one I always wanted to do and just kind of had that on the back burner and then got done recently. But we kind of looked at, the old Fama versus Shiller debate. Are markets efficient, and can you form a portfolio that basically times the market, for lack of a better word, based on the PE ratio? And so to kind of go back in time, Shiller said. Again, both of these gentlemen are Nobel Prize winners for their work here. Shiller said I think this is back in the 80s, he said when PE ratios are high, you should shift over to a bond portfolio. And when PE ratios are low, you should shift over to an equity portfolio. And so we did that. We went all the way back to the 1920s and kind of followed his advice and said, if you kind of shifted your portfolio back and forth between bonds and stocks based on the price over earnings ratio, would you do better? Would you beat the market on a risk adjusted basis? And we followed his kind of thresholds by which you would change your portfolio, and we kind of found not so good results. Back in the 1950s or before the 1950s, this strategy did work pretty well. But since the 1950s, it's underperformed if you were just in a 50-50 portfolio. So you would have been better off just putting 50% of your money in bonds and 50% in equity and not trying to time things since the 1950s.
Very interesting. And what do you think is the reason you just think that the markets are efficient and it is not possible to time the markets?
Well, it's funny. Yeah, it's definitely markets have gotten more efficient. That's completely true. But according to Shiller's own rule, you would have been in a bond portfolio basically since the year 2000 because P ratios have been very high. So you basically would have, if you followed his advice, you would have been totally in bonds or most heavily weighted toward bonds since the year 2000. And we obviously know that stocks have done very well since the year 2000.
So we talked a little bit about recession earlier, what kind of bonds do well during recessionary environments. And as I mentioned earlier, many experts are talking about a recession later this year because even though the Fed is expected to pause its interest rates hiking campaign soon, the lagging effects of those aggressive rate hikes are yet to be fully seen. And we have seen that inflation has started cooling a bit, but it is still expected to stay at elevated levels in the coming months. So the Fed may keep interest rates higher for longer. So one of your studies looked at other instruments and what type of stocks do well during recession. Please tell us about that.
So in this one, we looked back and saw how did stocks and bonds do leading up to a recession and how do they do in the actual recession. And it might not surprise anyone, but stocks do well leading up to the recession and then give most of that back in the recession. So for instance, the worst offender here would be international equity, which would go up about a percentage point each month leading up to the recession in the 9 months leading up. And then they basically go down a percentage point per month in the actual recession. So they go up and then they come crashing back down to earth. Bonds, on the other hand, do pretty well leading up to the recession and then hold their own in the recession. So bonds kind of deliver about 0.5% return leading up to the recession per month, and then a similar amount in the actual recession. The one that doesn't fit this trend is high yield debt. So high yield debt does not fit that trend and acts more like equity.
Interesting. So another topic that I wanted to cover today was this trading in options activity. And we have seen a boom in options trading in the last few years, particularly last year. Lot of speculation, a lot of trading in zero-day options as well. One of your studies looked at options trading, and you have a warning for those speculators. Tell us about that.
Yes, indeed. Yeah, it's a little troubling to see how much my students like or are interested in zero-date options trading. It's a little It's a little concerning. And so I kind of wrote this one as a point of caution, and I made them all read this just to show how much you are losing by trading in the options market. And I think this is known by a lot of investors. Comparing bid-ask spreads in the equity market to the options market, I think most people know that the options market has a much higher bid-ask spread, but don't really realize how much more. So we kind of tracked the most heavily traded options out there. And again, this is for the 10 most heavily traded options. We're not including kind of thinly traded options in this case.
I'm just interested, which are the most heavily traded options? Are those ETF options or index options or Tesla options? I know Tesla and NVIDIA options are very popular with speculators.
Yes, I think we categorize by volume. So SPY was up there. I believe Tesla was in the sample. I believe Apple, again, this was the most heavily traded over 2023. So Tesla, yes, was in the sample. Yeah. And so for that set of ETFs, we then tracked, how their bid-ask spread looked on a daily basis during the trading day. It should be noted, just at a random point during the trading day. And so what we found was for a stock or an ETF that might have a 1 basis point or a 2 basis point bid-ask spread, which was kind of the norm, we were seeing a 1 to 1.5% bid-ask spread in the options market. So 100 times the bid-ask spread of the stock market. And so again, these are for the most heavily traded options. And we saw that for options that were out of the money, you would pay a higher bid-ask spread. And for longer dated options, the bid-ask spread was a little bit higher. And again, we only included in the sample those that had positive open interest and positive volume on a given day. So these are not the thinly traded options within the set either. And so it's just a point of warning, just how much more expensive it is to trade options. And we didn't even go into the class of thinly traded options, which it's not uncommon to see some option out there that has a 5 or 6 percentage point bid-ask spread once you get to the smaller traded options.
Right. So all these costs add up, and it is very risky. So I read an article on Bloomberg recently that those 0-day option traders, they actually lost a lot of money last year. So definitely cautionary lessons for speculators. Excellent stuff as always, Dr. Hosmeyer. Thank you so much for joining us today and for sharing your insights.
Thank you, Nina, so much for having me.
That was Dr. Derek Hosmeyer. If you want to learn more about his research, please visit his website, derekhosmeyer.com. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.